I am Charlie Bilello, founder and CEO of Compound Capital Advisors. And I'm panicked about figuring out the settings on my new microphone.
There he is, King of Sweden. No, Norway.
You're insulting me by saying that.
Is Sweden truly an enemy? Who is everybody has a natural enemy. For me, it's women. It's half the world. For you, it's a natural enemy. I don't know how to talk to them. I don't know what they're thinking. Anyways, do you have a natural enemy? Is it Sweden?
I think Sweden is the closest thing ever.
Or is it the sun? Because then your oil goes away and poof, Norway's got nothing.
You're right. The green movement in Norway wants to stop oil production. They don't realize that's where the money's coming from.
The green movement are the dumbest form of Norwegians. You can't, it's not even, and how seriously are they taken?
About 4% of the people are taking them seriously, which is a joke.
4%. And what is the now teeming population of Norway?
Close to 5 million.
So there are 200,000 Norwegians who, they just want to live in poverty and darkness.
Yeah, they just don't realize it. It's all right. It's okay.
And anyway, so we all have our fringers.
We do.
Speaking of fringers, I have
great segue.
I'm king of segues. I'm not king of much, but I'm king of segues. How's my mic?
Your mic looks beautiful from here.
And I do this once a quarter. We catch up on the markets. I'd like to talk about the markets every day, but you know what? That was when we started the show in March of 2020 when panic was the topic of the minute. COVID unleashed its fury and America was panicked. Here we are now in the fall of 2021. Oil, which was negative, meaning you had to pay a Norwegian.
The green
people loved. Green people were like, all right, we'll take some oil at negative. Oil was negative. Facebook was working. And some point this month, Facebook wasn't working and oil hit highs not seen since 2014. Now, is there a bell that is rung in Oslo when oil hits yearly highs? Is there just some large Norwegian who runs outside and just rings a bell and says, we're rich?
Yeah, they ring it once a day.
So yeah, oil's cooking. We've got a lot of stuff going on in the markets. No fear. And so I like to check in with Charlie Bilello, who started an RIA firm. He looks after the liquid side of my portfolio. We invest together. He has a RIA firm that I'm involved with. Oh, he invests for you too?
Yes, he does.
Is he doing okay?
He's doing great.
You said that as if you haven't looked at your statement in a couple months.
I don't. I never look at it.
You are the type of client that we cherish at Compound. So, Charlie, we love to have on because he's prepared. He sends me what he wants to talk about, and I generally agree because he's in charge. And then Don Nitty at Social Leverage, who was on the hedge fund side forever, being yelled at, taking orders, giving orders, doing research, laying stuff on the line, always accountable to the mighty profit. That's how you get paid in that business. In the podcast world, it's much easier. You just don't get paid, no matter how popular you are, until Spotify comes out and says, hey, you're just controversial enough for our network. And I'm just not willing to be controversial enough. So we have Charlie on. We're going to talk about the market. Let me give you the topics today because I think it's important as we head into 2022. The markets have just had their slightest of slight pullbacks of 5%, which is the first time since November of 2020. And here we are, markets still rather screaming. Crypto screaming. We probably won't talk about crypto today, but maybe we'll work it in the conversation. But Charlie has some topics that are near and dear to him. One being right now, 0% rates make 0 cents. And why is the Fed still buying mortgage bonds? He's going to explain that. So will Don. Next topic for today will be the stealth bear market. I'm involved in some of these stocks. They've been going up forever, and now they seem to be going down every day. Inside a strong U.S. equities, there's a stealth bear market. That's why, Knut, don't open your portfolio yet. 3, the Delta wave and its impact on micro trends. So Delta, fly the friendly skies, and could be related to COVID. I think there's a variant. 4, the freedom premium, which is important as China crashes. And then 5, a time for prudence, something that Charlie and I talk about every time we chat, is like when. I hate the word conservative. I think one word, Knut, that I hate is conservative, not just politically, just it's kind of like when you go to try on skis and they go, are you a beginner or an intermediate or an expert? And I'm like, intermediate? What the fuck? I don't want to be an intermediate in anything, just I don't want to be conservative. I take risk or I don't take risk. So we're going to talk about those 5 subjects with the gents. And should we bring them on?
I think we should.
Okay. And let's ring up Charlie and Don.
All right.
Charlie,
Howard,
how are you?
I'm feeling good.
You're
How are
feeling
you?
good. That's about the most we will get out of Charlie right there.
Are you recovered from the biking? Are you still sore?
I am not sore. I feel good, buddy. It's quite a sense of accomplishment. I say this, as someone who plays golf. It's hard to measure athletic ability across the scale, right? Golf has handicaps. Biking has, the basic equipment. You can get fitted. You can be in better shape. You can blood dope. But we all climb the same hill in the end, and it's only measured by time. On a golf course, you can play different tees, and everybody's experience is a little different. Climbing a mountain, when it's all said and done, whether you're Lance Armstrong or myself, it's the same distance. It's just who does it faster, and obviously the pros do it incredibly fast. And riding the same mountain as them gives you some perspective. Something that takes me an hour and a half or 2 hours may take a pro 35 to 40 minutes. Whereas I'm doing 5 to 8 kilometers an hour or 6 miles, let's say, and a pro is doing 18 to 20 miles an hour up the same. So to have that context is what's fantastic in appreciation. Drugs or no drugs for these athletes. So I feel good. I'm not sore. I am feeling rather good. And then I have Don. Are we going to get Don on?
I'm here, Howard.
Hey, Donnie Nidhi.
How's it going?
Knut says he doesn't have a natural enemy. Do you have a natural enemy? When you're in the hedge fund desk, did you have a natural enemy? Was it everyone?
No, but I think my new enemy is you coming to New York and trying to organize a calendar for you.
Yeah.
So.
Well, then no one should have to do that. I just did it for you just so you could see inside my brain. I don't really need your help doing this. I just wanted you to understand how badly I run my life. And,
I'm going into hiding
test.
after this.
It's a test of the emergency broadcast system. So yes, I'm going to see Don.
I feel for you, Don.
Yeah, isn't that funny? Because Don is like, you can't shake him. Like Ellen talks to him, she thinks he's just so smart. Like Don will just say stuff that gets me in trouble just because it's level-headed. Like I'll go, Don, I'm the boss, and it'll say something so much more profound than me. And my wife will say, yeah, I'm with Don. I'm like, well, first of all, why are you listening? And hang up. And then second is Don generally is right about a lot of things. He's got a cousin, and anytime you mention something to Don, he goes, yeah, I got a cousin or an uncle. It's like, it's a pretty interesting thing. It's that New Jersey or Long Island thing. All right, but I want to get to the markets, which has been a great year, Charlie, for guys like you who just allocate capital. Right? Like you have a strategy, and it's about asset allocation. And it's been pretty hard to have a bad year if you have basic asset allocation. Am I right or am I wrong? Are portfolios up this year that just do general basic low cost portfolio allocation?
Yeah, I think it's if you have a U.S. centric equity portfolio that's mostly large cap, let's say S&P equities, you're up around 17% year to date, right? So the stock side, if you're just U.S., throwing everything else, the stock side's been doing pretty well. But as you know, the other side of the 60-40, the bond side is actually down this year. We haven't seen that in quite some time, so that's really not doing much. And then things outside of the U.S., particularly emerging markets, not doing so well on the year. And within and underneath the market in the U.S., everything isn't participated. So there's, what I like to call stealth bear market going on. It's really been going on since early in the year, since February for a lot of stocks. So, in terms of, yes, true, asset allocation, broad ETF portfolios doing quite well, but a lot of what worked well in 2020 in terms of riskier trades, whether it's SPACs or high growth names, or even the meme stocks that we saw earlier in the year, really peaked, either in January and February, and are having a tough time right now.
Yeah, I think, Don, we'll get into the 5 main topics, but I think, Don, I've been thinking about this, some of my tech guests, and they're saying, back 20 years ago, and this goes to tech hoarding, right? Like whoever's got the mic wants to keep the mic. And, before tech took off in 2010, I think it was Alex Danko said to me, before tech stocks took off in 2010, those who didn't want to participate in tech, those just hated, the multiples would say, oh, well, it's only because the Fed, but here we are 10 years later, and Jesus Christ, we've got some great tech products, forgetting just the returns. And now they're printing money hand over foot, and it's helping everything from climate type companies to biotech companies to, financial services companies. It's not just tech. There seems to be a chance to be, and here in 2021, we're seeing it in oil. So this kind of money is not just helping tech. And I think that's kind of one of the big stories that Alex Danko didn't know he was pointing out to me, but it makes a really good point. Maybe it wasn't enough capital in 2010, and now tech doesn't like it because there's more capital than just for tech. We've been printing money for so long, and this inflation is here that it's helping industries beyond tech. And I think this has been a tricky year for guys like me who like owning just software, where if it wasn't for crypto, it'd be a miserable year for me. And crypto is software for the most part. So, but at the same time, like old school financial software companies are having an okay year, but it's very mixed. So getting right to the topics you want to talk about, Charlie, 0% interest rates. What's your take on, government buying bonds here, mortgage bonds? I know you have a strong take on this, so let her rip.
Yeah, well, we talked about last time I was on the show, I think it was back in May, we talked about what the Fed was saying at the time and about the transitory nature of things. And we were questioning, does that make sense given what's going on? Is this really going to come right back down by the end of the summer? And, here we are today, and we can see that it's not proving to be nearly as transitory as we were promised. And if I stood here today and we knew nothing else, we didn't know where the Fed policy was at, and I just showed you what was going on in the housing market, with housing prices up 20% over the last year, the highest rate of increase we've ever seen in a one-year period, obviously at all-time highs. Every single major metro area in the country up double digits, led by, of course, Phoenix, your hometown there. And I told you that unemployment rates at 5.2% and going down, and expected to continue to go down. I told you that there were 10.9 million job openings in the U.S., which exceeds the number of unemployed by a few million. And I told you that GDP growth was at 6%, over 6%, and expected to continue to be strong in the coming quarters, which is the highest rate of growth we've seen since the early 1980s. And I told you, Howard, guess where the Fed funds rate is, and guess what the Fed is doing in terms of their balance sheet and quantitative easing. What would you say?
Say raise those rates? I'd say rates are going higher.
Yeah, you probably wouldn't say rates are at 0%. I'd expect it to stay there for until the end of 2022 for at least another year. And you most certainly wouldn't be saying, given what's going on in the housing market, that the Fed is still buying $40 billion of mortgage bonds a month, with mortgage rates where they are and with the housing market on absolute fire. If we look at the ratio of new home prices, median new home prices to median incomes in the U.S., it's now at the highest level it ever was. So just thinking about that and thinking about, well, what is the Fed trying to do here? It's hard to come up with an understanding. It doesn't really make any sense given what's going on. other than that the Fed needs to keep rates low because of what's going on in the debt markets, and they're afraid of what will happen when they normalize. So it's just a fascinating time to look at policy, and we all know that it has to come to an end. And most importantly, and this is what we talked about last time, the Fed will only end it when they're forced to end it, and when people start talking about inflation as being a bad thing. And a few months ago it was, a little bit of inflation, that's fine. Our wages are growing up, and we can handle it, no problem. That means that growth is going up. And today, the tune is starting to change. You're starting to hear more stories and more people talk about price increases outpacing wage gains, and that's when it tends to become problematic. So on that front, we're seeing a change now in terms of expectation. The Fed is talking about finally starting to taper, perhaps by the end of this year, and moving up their interest rate hikes perhaps to 2022, when initially they were talking about 2023. But the broader point is it's still extremely easy monetary policy, given what's going on in the markets, given what's going on in asset prices, and given what's going on in the economy.
Yeah, I'll pass it to Don, and then I'll throw in some comments. Don, same issue. What's your take? I mean, we're on both sides of this, all of us. I'm wealthier because of it, but everything I want to buy is way more expensive because of it. But it's still a net win for me, so I don't know where I feel. I mean, my overall take, Charlie, is the market has been politicized. So until, like you say, until the world demands that the politics of it does the opposite, the government's just going to keep kicking the can and politicize wise don't lose the election because of the stock market. And then on the other side, because of that, we have a whole new stock market for people who don't want training wheels, which is Wild West. Go on Discord, pump a stock, pump crypto. There's nobody to cry to in DeFi. There's no one to come to your protection if you get hacked, or you know what I mean? So you kind of have the best of both worlds, right? Like you have training wheels, and like you can trade against the Fed if you want, 10 to 30% returns. But if you want to let her fly, well, I guess you can do options in the real world in the stock market, or you can go into the crypto world and take what you've learned in the regular world and apply it to crypto world and just let her rip. Like, Don, what are you seeing on the same subject?
Yeah, I mean, we've had this conversation, even, 2 weeks ago with the Evergrande news, that big down Monday. And, I was telling on the partner call, price dictates news. We kind of knew that was coming. Evergrande was down big the week prior. We saw the news and the headline for weeks even before that. And, you were watching rates. I think everything is essentially in the market. It's just a rotation, based on what's the rates trade. Is it, short value, buy growth, or short growth, be long value? If you look at what happened yesterday in the market, the best performers, you had commodity sensitive, bond proxies, and long value. And the short quality and GS VIP basket were the worst performers. So, I think funds are positioning themselves, post-Fed comments and what they've been talking around tapering. Right now they're saying tapering is expected to begin in November. They're looking at $15 billion a month ending in June of 22. So I think anything less than 15 billion, if they come out and say, okay, we're going to taper 10 billion a month, it's probably going to be considered dovish, push the equity markets higher. But where does the rotation happen at that point? Are people going to now be offsides growth and pile back into them? Or you're going to get people saying, valuations have gotten a little far ahead of their skis here. And then to go into the, transitory, is inflation transitory? And you look at commodity pricing that Charlie mentioned being at a 6-year high, and car prices, and a few other factors. But, one of the things conversations that I've had with some CEOs of private market companies, and, they're saying, well, we do think it's transitory. This is kind of what we're being told. But at the same point, we're doing some price increasing, due to offset some of the input costs. So if it is transitory, which we're being told, and they have price increases, not saying it's going to happen, quarterly or yearly from here. Is it a one-time price increase? But if input costs go down, margins will get better in some of these businesses. So, Yeah, I think right now we're very long in the tooth in the market. I think the easy money was made in 2020. And now it's kind of, tell me where the 10-year is and I'll tell you what's going to happen in the market and where the rotation's going to go.
I like that. So going into, well, what's happening then is you're seeing this rotation, and I'm seeing it in my 8 to 80, handpicked portfolio, which has had years and years of epic gains. And now peak to trough, I'm seeing, from Zillow, which had a ridiculous 1,000% run up from the panic lows, the COVID lows, Zoom, Peloton, same thing. They're all down 50%, which if you, paid peak price for them, late last year or mid last year, you're down 50%. But you're not really, because these things had great run-ups. But a drawdown is a drawdown, and there's a stealth bear market in these, Charlie. I'm not scared of them because I know where we came from, and these are brands that are going to work in any economy. But at the same time, how do you deal with this kind of stealth bear market?
I think the broader point here is a change in market environment. So what we had late last year heading into this year was just extreme sentiment, and investors kept moving higher and higher up on the risk spectrum. So they started with high growth names last year. That wasn't risky enough, so they went into IPOs. That wasn't risky enough, so they went into SPACs. That wasn't risky enough, so they went into meme stocks, and then Dogecoin was probably the pinnacle. And there was this notion that, stocks only go up, right? You probably remember who coined that phrase, and that can only end in one way, where people have to realize that just because you take more and more risk, you're not necessarily going to be rewarded for that. And so we've seen that, and we talked about SPACs early in the year. I think it was probably the most glaring thing, and Howard and I had talked about it many times. You just can't have that much supply, $1 billion a day in new issuance through the first few months. We're at 130 billion now, which is far exceeds last year's record, but really most of it had happened in the first 3 to 4 months of the year. You can't have that much supply without a consequence, and the consequence being these things have repriced, right? So whereas they were all trading at unbelievable premiums in the SPAC market in January and February, now I think more than half of them are trading at discounts. Now we can debate which ones are good or which ones are bad, but you've had a repricing, and investors there have learned that just because you take a risk in these speculative things, you're not going to be rewarded. So if we look at something like the SPAC ETF, it's actually down 20% year to date, where the S&P up until a few days ago was up over 20%. Right. So that's one area of the market. The other thing that we're looking at, as you mentioned, these high growth names, which many of them had pulled forward demand last year, and everyone had talked about it, and they became very hard to price. So something like Zoom just became so much more valuable, and it's hard to understand how you can pull forward 10 years worth of growth into 1 year. And they're still growing, by the way, right, in the last few quarters this year. But it's hard to say, is it worth 50 times sales, or is it now it's down to, I think, 20 times sales, right, or somewhere in between. And we'll see there where that shakes out. Same situation in something like Peloton. So we have a repricing in these names that benefited from COVID, and now we're moving to a post-COVID world. It doesn't mean these technologies and these brands aren't going to be use cases and not going to be useful in the future. They absolutely are. The question is, were the investors paying too much, as a multiple of sales, and they've all been repriced. So it's a different type of environment now, where investors have to think about the risks they're taking. Whereas, for a bunch of months last year and heading into early this year, they just had to go into the most riskiest area they could find, and they would be rewarded.
Yeah, and a lot of the spec traders from last year have learned crypto, or think they've learned or found a new toy. And I always say supply will kill this one, because it ain't going to be rates. Even though we're talking about the rates rising, we're still at 1.5% on the 10-year. So it's supply that's killing it. And right now it's just, there's a second market. It's called crypto. It's digital. It's 24/7. It's 365. That's a lot better casino than just chasing a COVID portfolio like Peloton and DocuSign. And so I think you've got competition for risk capital or high growth. And why deal with Peloton when you can deal with something that's just pure software? So you have all that going on in this world, Don, for your own portfolio. Now that you're doing it for yourself, because you're helping us on the venture side, that when the topic becomes a 10-year, how are you looking at the world? Are you just trading more and having more cash, or is there a point of view that you have here?
I mean, I've been pretty on the sidelines over the course of the past month. I mean, I think the fat pitch setup, like I said, that Monday, I thought it was a pretty fat pitch because, you had a down, whatever it was, 3% market. You had the Fed coming up on that following Wednesday. You had turnaround Tuesday in between. And, the Fed's watching. One, they're scared of their own shadow at this point. Two, they're looking at the market saying, this is over Evergrande. Imagine if we came out and were somewhat hawkish, what's essentially going to happen to the equity market? So I think that, that was kind of a fat pitch setup to get long as a short-term trade. But I think right now, the one thing going, if you're looking, there's two things. One, bearish sentiment right now is at extreme. So bearish sentiment index, it's reached bearish extremes we haven't seen in a year. Two, you have seasonality. So the S&P is up 16% year to date. There's been 18 instances since 1950 that the S&P is up at least greater than 15% during the first 3 quarters of the year. In the previous 17 instances, the median return for Q4 has been up 5.4%, and that's Q4 only. And then the other thing that I look at, what Charlie touched on, is if you look at new issuance for the year. So new issuance in September was $45 billion. We had 123 deals. That's the 10th most for a single month dating back to 2000 on a notional basis. And then if you go back to SPAC again in March, we raised, it was $96 billion was raised in 269 deals. So you had all this SPAC new issuance. But, there's still appetite. I mean, if you look at the September numbers of IPOs, there's still risk in the market. One of the tricks that I used to do was, walk in on a Monday morning and see how many biotech IPOs were launched, and it will tell you if it's a risk on or risk off market for the week. So, I think you're looking at a bunch of stuff with seasonality. The other big thing, too, that, I paid attention to was, the buyback blackout period. 94% of the companies in the S&P right now are in blackout. So that kicked off, third week of September. So what happens when the buybacks come back in, the 105B plan. So, it's going to be interesting, but I think it's, seasonality is telling you to be long into Q4.
All right. I like it. I'm with you. I was nibbling yesterday with you on the phone, and Charlie, I bought some Cloudflare for myself. I'm eyeing some new names as the world changes. The world's opening, as I consider my 8 to 80 type of brands that can, survive through thick and thin. We're now a post-COVID world has a little more, I don't know, it feels a little more stable to think through longer term trends as we see the price action of the leaders through COVID, and see kind of like I'm seeing Netflix break out, and I'm like, there isn't a company better situated of the FANGs post-COVID because, government doesn't really give a shit about them. There's tons of competition for our attention. No one focuses on how really great a product Netflix is because we kind of took it for granted through COVID. But that was a company that just couldn't really do much, without breaking the law. Like the people had to wear masks, actors were, Hollywood was kind of shut down. And here we come out of post-COVID, and there's just going to be a plethora of creativity and content. Netflix is just going to be full tilt, endless content that you will be behind in for the rest of your life. But not anxious about it because there's always time on a plane or somewhere to watch this content. I think Netflix, even with the competition, even Jeff Bezos was out there on Twitter saying how great they're executing internationally. So I think the best big company coming out of COVID is probably, I would say, Netflix and Google, just because they are the least evil of the FANGs and came out of COVID, in my opinion, the most unscathed. So going on to the third point, Charlie, that you want to get on is the Delta wave. I mean, didn't affect me because I was traveling and vaccinated and going around the world and acting as if, not as if I was invincible, but like, give it to me and, I can handle it. But there's a huge impact on the macro trends, or what do you see as the Delta wave's impact?
Yeah, I think where we were at the end of June, we were feeling pretty good. We were in a good place in terms of cases, hospitalizations, deaths in the U.S. were all at pandemic lows. And then we started seeing what was happening in the UK and Israel with the Delta wave, and we took our turn. And just the contagiousness of it really was the main factor, just at least 2, maybe 3 times more contagious than the other strains. And that led to just wider spread, I think, than people thought. And what you started to see was a little bit of a pullback in the trend in terms of air travel started to decline a little bit as the numbers went up. You started to see other impacts in terms of even commodities came down briefly. Anything related to the reopening trade took a hit. And on the other side, you saw a rebound in some of the tech names and growth names going in the other direction. And then interestingly, when the Delta wave started to show signs of peaking, about a little over a month ago, you started to see a reversal in that. And that happened very quickly. So the macro trades are playing off that very much so. So what we saw during the Delta wave going up, we saw yields falling. The 10-year came down pretty significantly. We saw in terms of commodities, they were coming down. We saw a lot of different trades kind of moving the other direction. And as soon as we see some light in terms of things getting better, we're seeing the exact opposite. So crude oil now at its highest levels in some time. We're seeing not just crude oil, but other commodities as well, across the board, natural gas at its highest levels in a while. So you're seeing the market saying that a reopening in the economy is going to lead to perhaps a longer term secular shift in terms of growth versus value, with value starting to do better in terms of other sectors like financials and energy starting to outperform tech. And these were trends we saw early in the year before the Delta wave, and now they're coming back again. So I think longer term, if COVID can hopefully get milder and milder, which there's every indication that it will with each subsequent wave, the interesting thing will be to see if this trend persists. Because remember, coming into COVID, you had these long-term trends of yields falling, you had energy underperforming, you had commodities underperforming, you had value underperforming for 14 years. And the big question for long-term asset allocators is there going to be a shift? And, we talked a little bit about, some of these high growth names pulling back, but really, the big four haven't, with the exception of maybe Amazon, haven't really shown too much weakness relative to the broad market. And I think that's the big question is for next year and the years after, is this going to be a longer term shift where we see yields finally moving up in a meaningful way and perhaps value stocks outperforming and commodities, having a run like they did in the early 2000s.
And Don, what do you see?
Yeah, I mean, I think, with the Delta wave, a few tidbits that I think are pretty interesting. Jets, the airline ETF, is still 22% off its pre-COVID highs. We had Delta come out on Sunday. They're saying they're continuing to see improvement right now. Third quarter revenue, they're saying they expect to be within its original forecast of a 30 to 35% drop versus 2019 levels. And then, one of the things too in the airlines, business spending is going up as far as travel. JP Morgan had a report out this week talking about that. I think the one thing that investors buying these airlines, and, Charlie was talking about the SPAC market and, overhang of supply on the issuance. But, we had in, 2020, the airlines got a $25 billion U.S. government bailout. That doesn't include all of the secondary finances that went on within travel, if it was Carnival or the airline stocks, whatever it is. So, I think as these continue to rally and you have, numbers continue to stabilize or improve, you're going to see the folks that were doing those deals down in the hole continue to sit on these stocks and divest some of them along the way. Not saying they can't go higher, but I think that, at a certain point, there's going to be a lot of supply overhang and they'll hit a wall.
Yeah, really good stuff. The next point to talk about was what we're thinking about this freedom premium. I gave up on China. The only two companies that I kind of felt were too big to cheat. And maybe I was right, but I forgot about the fact that they were too big to leave alone by Z, was Bubba and Tencent. And I kind of gave up on them a few months ago. And so far, so good, because it's just been painful since. This freedom premium, or whatever we're going to call it, is there anything that you're hearing or seeing in the numbers that makes you go, like it's gone too far?
Well, it's good to look at the history and try to get some context. So I kind of coined this term, the freedom premium. And all I mean by that is that, ask yourself this question: should economies and companies that have shareholder rights that are stronger and have more freedom in terms of entrepreneurship and innovation, should their stock market trade at a premium to other countries where that isn't the case? And I think it's hard to argue that they shouldn't, but one might assume that has always been the case if we look at the U.S. and China, but you don't have to go back too far to see that wasn't. So in 2007, China had this enormous run-up. It was growing at double digits. At least that was the reported GDP growth. You could believe those numbers or not, but that's what they were reporting, and the stock market was exploding, and U.S. investors were falling over themselves trying to get into China, and they were actually trading at a multiple significantly higher than the U.S. at the time, which wasn't cheap, of course, when U.S. equities peaked in 2007. Today, we have a very different situation, particularly after what's gone on this year, where the U.S. is now trading, if we look at something like the CAPE ratio, at double that of China. And the tough part as an investor now is you have to ask yourself, well, is that correct? Is there too much bad news priced in perhaps to China? Or people overly optimistic on the U.S.? But I don't think there's any question that you have to think that the U.S. should trade at least some premium given what's gone on. I look at something like Chinese GDP, which has been for years, and there's been a number of studies that people have questioned the validity of the numbers there. But if you go back, let's say, the past 25 years, and you look at what they've reported in terms of GDP, they say they've grown around 6 to 7% per year, real GDP. And then you look at the MSCI China index, their equity index, and you see that that's advanced about 2% a year. Whereas U.S. equities have gone up over 10% a year over that time period. And then you have to ask yourself, well, how much of the numbers out of China do you believe? And, what is real and what's not real? Is it possible for the economy to grow that much and shareholders to receive so little? Perhaps it is. Perhaps it isn't. But I think we've learned, particularly after COVID, that you should question pretty much everything that the CCP is putting out. They have control over the data of all these major companies in China, and whoever controls the data of these companies ultimately controls the companies, in my view. So that's not to say that a broad investor shouldn't have any exposure to emerging markets where there's going to be more hair than the U.S. markets. You have different fundamental drivers, and over long periods of time that might serve you well. But I think you do have to question certainly buying any individual stock or sector in China. If you look at what they did with the education sector pretty much overnight, saying, we don't think that these companies should be profitable. We think they're taking advantage of people. We don't want a culture that has students competing against one another in terms of having tutors and paying too much for this. This is hurting the family. So we're going to just stop it overnight, and these things just crash. They're down 80, 90% or more. So there's a lot to talk about there, but I think the main point investors have to think about is, how much do they trust in China, and what is the premium for having a free economy? If you look at what happened to Jack Ma in terms of what he said, which really wasn't very much if it was in the U.S., and what happened to him, is that going to inspire future entrepreneurs in China to be as successful as he was?
Yeah. For me, it's like Mexico, even though it's close and I can go visit it if I wanted to. It's just like, fool me 72 times, I'll stop doing it. And it's like, if I really want risk, I'll just trade crypto. At least I know who I'm trading against in many ways. And I'm a big boy and I know the results. It just seems so rigged. And it's so funny because the millennials are getting made fun of for trading crypto. But like, if you really look at how Alibaba was put together, I don't even know what people really thought they owned. Even if the CCP or whatever we're going to call them, or Z, were acting in good faith, right? Like, you didn't really own anything except a derivative of an offshore entity. How did you feel about when you were trading it versus today? Do you even go near them, Don?
China scares the hell out of me, having capital put to work there right now. I'm convinced Jack Ma's still missing and he's a weemy hologram. But yeah, the scrutiny around the government and the VIE structure, and to Charlie's point, what they did with the educational stocks, and then, around data privacy, it just feels to me that there's too much, geopolitical. Like, do they even want their companies listed in the U.S.? Are they going to, hopefully delist them in the U.S. and move them to Hong Kong, and what's going on there? The macro uncertainty, to me, the overall risk reward is not there. Are some of these companies cheap on a multiple basis given their growth rate? But are you going to get rewarded to take that risk, right? I think that's the biggest question around it. And then to the GDP stuff, I remember back in 2010, 2011, the conversation was, look at China GDP growth, but you also had at the same point, construction spending in China was through the roof, and it was all these ghost cities that were being built, right? So what numbers were actual factual versus false? And then, one stat is, what's the fastest company to get to $1 billion in revenue? And it was Luckin Coffee, right? So like, there's another use case for you, but I just don't think that the risk reward there to be long China right now. It seems like a massive decoupling.
Yeah, I mean, culture-wise, what always shocked me is like, coffee has margins. Why do you need to cheat? Like, the fact is, you're cheating around. It's one thing to cheat around like a commodity or around faking numbers, but like, why do you need to cheat with coffee? Like, there's no bad coffee businesses. The margins are insane. So it's just those things that they do. I don't know if it's just built into the culture of cheating and just the way the government is structured, but like, I don't know. I feel dumb for even. In the end, Tencent was very good to me long term, but it just feels like I never really understood it. It's just kind of lazy investing, which is why, I just punted.
Right, Howard, it's in your defense, right? If you're just looking at, and as Don alluded to, if you're just looking at the fundamental growth rates and even the expectations from here for Alibaba or Tencent, they're phenomenal. But how much is the end investor going to receive of that? That's the question in terms of future profits. I mean, when you have the CCP saying they're not paying their fair share, we want them to pay more for the benefit of society. And how much is enough? I don't know. I guess they're negotiating that. Do you believe the revenue numbers there, or will they, certain business lines? These are enormous entities with many different businesses. Do you believe that they're going to let them remain that powerful and that intact when they get to a certain point? So, it's difficult to trust anything coming out, right? This is a country that initially during COVID lied about how the virus could be spread. They said it couldn't be spread human to human. This was in January 2020, and then we have evidence now that where they knew that it could be. Then they lied about the severity of it, right? And they pretty much silenced anybody who was talking about having a relative die. They took all of those posts off of their version of social media there. And then they lied about the origin, right? Saying it came from a wet market when there's pretty good evidence. The lab leak theory, I think, is pretty credible at this point. So, I think it's pretty difficult to believe any number after what we've gone through in the last year. And the notion that you can have a little bit of freedom, right? You can have censorship and propaganda and internment camps and, really a surveillance state, but then have free markets and everybody wins and it's okay. I think we're starting to question the notion that will end well for everybody involved.
Yeah. I mean, I'm so done with China. And I'm not done with it for all the reasons that you say. I'm just done with it because I have great choices, and it's fun to watch fractionalization and decentralization and culture and arguments over the value of a purse or a card or a book. But they're markets, and they can peg it to something that is quite fascinating to me versus arguing about these macro things in China. Let China worry about this. I think China wants to focus internally, so let them.
Howard, what do you make about them? And they seem like this is the 100th time they've done some version of this, but saying any crypto transactions will be illegal. I put a poll out on Twitter asking if you think that's better or worse for crypto ultimately long term. But what's your take on that?
Well, my take is I'll stick with the smart people and I'll stick with the price action, which says every time they've done something like this, it's been good long term. If it truly is decentralized like Bitcoin, every time they do something like this, they're only hurting themselves and helping crypto. If their ultimate plan is to have their own digital currency, it'll work for them because it replaces paper. And paper seems to me kind of stupid in 2021, but that won't hurt Bitcoin. It may actually increase the value of Bitcoin because the Chinese people that don't trust the digital currency will do everything they can to figure out how to own Bitcoin somewhere. So, it's like Jurassic Park. Everything comes down to movies in Hollywood. You build a fence and the velociraptors get through it and the T-Rexes get through it. And I don't know, they find a way. And this is basically just Jurassic Park digital version. And Bitcoin is the perfect product at the right time. And just like the internet going down with Facebook, that doesn't kill it, makes it stronger. And there is no cure. There is no Merck drug that will stop crypto at this point. 10 years, 11 years in, it's had everything thrown at it. It's kind of a weapon of mass decentralization. So I'm bullish. I don't know if that means it's going to win. There's something just won't come along that's better and more efficient and more trustworthy, right, and easier to use and manage and mine. But it's pretty damn good.
Yeah, it's kind of saying that they could stop the evolution of money. And I guess if you view crypto as the ultimate representation of freedom, then having China banning it is really telling you something. It probably does increase its use case, and it's just the story behind it, right?
Well, it may reduce its use case, but that doesn't mean it won't increase. Like gold doesn't have many uses, but the value continues to go up.
Well, in terms of China banned Google, right? Did that make it more valuable or less valuable?
I don't know. I have to go back. Google sold off Baidu, which was their form of maybe saying get out of China. It didn't hurt Google. It didn't hurt Baidu. I think this is just another form of a fork. China's trying to figure out internally how do they move to a digital world, and they don't want Bitcoin to be their China yuan dollar. They want their own digital version of it. So maybe
they want control, right?
They want control.
They can't control.
And this is something you can't control, so it's like a modern version of gold. I mean, when I think of gold, I just think about all the religions and the thousands of years of persecution and death and hoarding and fighting over this yellow metal. And pretty good that Bitcoin could be worth this much. I'm super just bullish on how digital and decentralization is just befuddling the governments. And, you see it sometimes with great teams. They just make the other teams look silly, when it was the Warriors that were so great and just no teams look good. I think crypto's just doing that to all these great minds who thought they had macro contained, and along comes this. And I think all the great macro minds are slowly coming towards crypto because they have an open mind. Any great mind is an open mind, and crypto is forcing people to change how they think about macro. But we could spend hours on that, and I'm not going to let us. So last but not least, I hate the term prudence, but since I'm 56 and we manage other people's money and we try and be responsible, I have this great story, and people don't remember his name, Andy Kessler, who, I forget the name of his book in 99, but he was running a momentum tech fund. He was at Bell Labs. He was struggling to raise money all those years of the tech boom. And then, boom, he had a hot hand, got a lot of great stocks through the 99, 98, early 2000. He went out to raise a fund, and he raised like $400 million from Arab investors, on his way to the meeting. And not only did he not take the money, he shut down his other fund, sold everything, used that as a signal saying this is the end. And that was in, I don't know, March of 2000. Top ticked the market, returned all the capital to his investors, and now he's, in my mind, a famous, prudent, or you call him crazy, but like he had a vision to say enough's enough. When you hear that story or talk about prudence and you see the stuff going on today, where are you at, Charlie, and then we'll end with Don?
I think it's important for investors to have context because 10 years can feel like an eternity. In the last 10 years, certainly for all the new generation of investors, all they've known is buy the dip and it working. So if we look at the correction we're in now, it's the 25th correction greater than 5% since March 2009. And if we look back at the previous 24, whether it was the COVID crash last year or the 20% declines in 2011 or 2018, without fail, no matter what the size, the market was back at new highs within a short period of time following all of those declines. And that really is a feedback loop that led to investor confidence being where it is today. So you have to just think, are there other periods in history? Is it possible for the next 10 years to look different than the previous 10? And how do the previous 10 compare to, let's say, the last 100 years? And if we look at any number of metrics, we could look at valuations, highest with the exception of 98 through 2000. We could talk about Fed policy, and is it possible for it to get any easier from today? I guess they could go to negative interest rates, but not likely. So we could talk about just the smoothness of the ride in terms of if we look at things like a Sharpe ratio and compare it to history, we're pretty much in the smoothest 10-year period you could find. So if you believe in mean reversion and you believe that over long periods of time, things that have gone in one direction may move back in the other direction. If now is not the time to be a little bit prudent in terms of risk taking, I'm not sure when it would be. That said, in terms of picking a top, that's impossible and certainly get crazier from here. We saw that in 1999 into 2000 when people thought valuations couldn't push higher, they did. But I would just suggest we're already seeing signs of that, as we talked about, in terms of the SPAC market, in terms of the high growth names, in terms of meme stocks. And Howard, you like to tweet the phrase sarcastically, investing is easy, right? And I think you've done all that quite a bit in the last year. Yep. But almost every one of these periods where we've seen investors chasing these meme stocks higher, in almost every one of the cases, they've come right back down. I guess the exception would be the big two, which are more than 50% below their highs, AMC and GameStop. But the rest of them, investors have been punished for chasing, right?
Yes.
So the way I look at prudence is think about the future. Think about how much of a drawdown you can handle. Think about diversification, maybe holding more cash, finding ways to diversify in terms of asset class or style, because the next few years, just based on probabilities, are likely to be harder than the last few.
Yeah. I'm going to let Don wrap up here, but I have a bunch of things to say. I think if you look at the best hedge funds, whether they're Loeb, and I know a lot of people inside some of the big hedge funds, and they tell me how the sausage is made, including Don, who doesn't share secrets, but I get enough insight from calling hedge funds and talking to them about private trading information, not inside information, just trading information, how things work. And I think the number one thing as the world moves retail is to know that these Loebs and the other people that we look up to, the Ackmans, I see some of the investments they make and I just shake my head going, I'll text Don and I go, I cannot believe they put money in this. And so I don't know. These people are chasing just like you're chasing. There's a million ways to get to 10% a year. And sometimes you can get there by risking 1% of your 100% 3 days of the year if you wait patiently enough. And sometimes you got to invest 110% of your capital every day, leave it invested to get that 10%. But there's more than one way to do it. I think so many people are looking for the perfect way to manage the market. And there really is only one way for each person. And there's a million ways to get to 10% or 12% a year. And for each person, it's a different path. It's a giant game. And I think that's why Robinhood and Coinbase and FTX and all these great companies that are just handing the controls to the player are doing so well, right? Where you've got your statement, you've got your dollar amounts, and now you're in control of driving that value up or down into the ground or to the sky. And there's a million ways to get to the goal. So, Don, how do you think about prudence right now? You got kids and new career, et cetera.
To Charlie's point, if you look at the last 10 years in the U.S. equity markets and what have been the real big drawdowns, you had, Trump, China trade in November of 2018 led by, they looked like the Fed were going to come out and do 3 hikes. Market puked, then rally. I remember the first week of January, then Apple pre-announced negative, and that seemed to be a bottom. Market rallied for the rest of the year. Then obviously COVID happened, and then the Fed stepped in with monetary and fiscal policy. And, Howard, you've been obviously super bullish with the do-it-yourself investing. And if you look at kind of that cohort, what have they seen, right? They've only really seen, let's say 2018 to current. And to Charlie's point, every, dip has been bought, pushing the market to new highs. So they really haven't seen something where, we don't make new highs, but at the same point, I think, a lot of the retail community, the guys that were trading all these meme stocks, and if you look at, if it's GameStop, AMC, Bed Bath Beyond, or, Tilray and whatnot, the rotation from out of the equity markets, when Doge went berserko, which was a massive movement in itself, and you just look at the adoption of some of these new crypto platforms, Axie Infinity put out their numbers last night. We saw a tidbit post the announcement of that massive round they raised. But, those numbers, the acceleration in revenue was just completely mind-blowing. They went from 16 million in revenue in Q2 to 782 million in revenue in Q3. I mean, it was 48x growth in one quarter. So if you think about kind of where the rotation's going from the retail community and kind of how they're positioning themselves, everything has become active and do it yourself for the younger generation, and then the speed of the internet, obviously, and how information's passed along through the Telegram or Discord chats or whatnot. I just don't know if we're in an environment where they even give a shit if the equity markets would collapse and dips weren't bought, because they're going to try to figure out another outlet to where to invest their capital. But if it doesn't get bought and, crypto crashes and the equity markets crash and everything else goes to hell, I think we could obviously have some big issues in our hand. And, the respect for risk, I mean, I just don't think it's there. I mean, I think, for myself, I've seen the GFC and I've seen other markets and how to kind of, position myself if I want to go more cash and less equity, or, sell some crypto holdings and divest some stuff that I've made some gains in. But, on a fundamental basis, you look at the S&P, for information technology price to sales, the FANG's been between 3 to 5x sales on an average as a group. So, it's fairly stable. And then, if you look at their impact on market multiple, you do 2.7 times sales, ex FANG, you're at 2.55. So even with massive weight and revenue share, it's trading mostly in line right now. And 2021 is the fastest revenue growth period for S&P Infotech. It's 18%. That's in the last decade, since 2011. They're forecasting 9% for 2022, so it's above the average. So just seems to me that people don't think the Fed's going to spook the market. Seasonality's in favor, and we're going to get these pockets of rotation based on rates. But overall, the consensus to me seems be long into Q4, is what the message seems to be on the street.
Yeah, Charlie brought up the investing is easy. I think in January of this year, I just started using that. It started, I think, with Kathy Woods. Like, it was just Kathy Woods 24/7, 365, which is somewhat inspiring, right? Like, we need our next Gabellis or whatever we're going to call them. We need our next Warren Buffetts. But, they were just dooming her. The media was just dooming that she got all the capital, which is the end game, suck up all the capital. Who cares about the return because you get paid on the capital? And of course, everybody chased. And now I think she's down on the year, Charlie, or heftily down.
Yeah, I think down over 10% on the year. And most of the investors who came in, a good amount of them are probably underwater.
20 to 30%.
Which is amazing, even though she did so phenomenally well last year.
Yeah.
And years prior. So when FOMO takes over and asset AUM always follows returns.
Correct. Chasing anything, chasing a dog into the street, chasing a cyclist up a hill when you're not fit enough, you will, you got to be honest with your internals. You got to be honest with your system.
Something that goes up 100% can go down 50%, and you have to be willing to withstand that. And the investor expectations, if you talk to people in January and February, I wrote about this in February, almost on the day where it peaked. I spoke to someone who said, that the fund was up over 100% in 2020. Even if he got half of that going forward, he'd be fine. So he'd be fine with a 50% return per year. So that's where investor expectations were. That's how high they were at that point. And that's why the flagship fund was raising $1 billion a day with those expectations. And the interesting thing so far, and I think we'll probably see it in the next few months, but we haven't seen it yet. What you tend to see when a fund like that has had inflows coming in almost in a parabolic fashion, when it has a drawdown, you tend to see assets move out at a higher rate than the fund. So the fund's down a little over 30% from its peak there. And assets are down just about the same amount, meaning they haven't had additional outflows beyond that. And that's very atypical. So far, investors have kind of stuck with it. But, if this goes on for another few months, if these investors are like any other investors in the history of funds, they will start to bail and take losses and chase the next thing that's working, probably a commodity fund or crypto or any number of other things, right?
So I agree with that on the institutional side of kind of where you're going to see fund flow. I think for the retail community, though, a lot of these, the Robinhood kids who were buying, GME and whatnot at all-time highs, the thought process for them was, we just got a stimulus check from the government. So if we lose $1,500, it wasn't ours to lose anyway. So who gives a shit?
Yeah, there's just no concept.
Yeah, they'll rationalize. We're in our 50s. We can't rationalize it anymore. We have to do, I hate using the term prudent, but I'd use it over the term conservative. I'm not conservative. I consider myself very aggressive, but I keep a high cash position as part of my aggression, right? Because I think it's prudent. The thing that kids...
you've lived through, Howard. You lived through 2000 when the market peaked. It took 7 years for it to get back to a new high in 2007, only to be hit with a worse drawdown for the S&P. I think it was 58% until it bottomed in March 2009. And that took 6 years from the peak in 07. We didn't hit new highs until 13. So, you've gone through two major periods there where you had to wait years to get back in terms of just the broad indices, with many stocks obviously never recovering from that, right? So, just having lived through that, you don't have to go back too far. It's just the prior generation has had that. And that's been a liability, by the way, having had that experience, because it's still in the back of your mind that it's possible.
Yeah, that recency bias takes a long time to wear off, and all the great investors go through it, whether you were a VC after the 2000 crash or a tech investor after 99. And, I think the number one thing here is, chasing, whether it's people or stocks, is dangerous. You can get away with it once in a while. But in the end, you surround yourself with a tight group of people. This is a team sport. It's my money, but I decided to make it a team sport. And I've tried to build the strongest team around to be able to pick up a phone call. It's like my own personal trading desk. I think the biggest mistake people make is they don't form a good team. They talk to too many people. And the sooner you write down how you really feel about how you want to make money and how you want to do it, the better, because that'll force you to read less. And there's nothing wrong with reading, but read fiction, read stuff about people that have been successful, but just reading endlessly about macro in the markets will just confuse you. You've got to find people that help you, reach goals. So I appreciate you guys checking in on this quarter. I think you guys have met in person, haven't you?
We haven't.
No.
Okay, so I'll coordinate that in the next few weeks in New York. We'll have a beer and catch up on all this stuff. Charlie with Compound Capital Advisors. He's prudently taking care of me and Canute.
Yep.
And then Don, who I have to talk to way too much, but and Charlie would know what that's like. So you can commiserate with Charlie when we have a beer. And you guys can talk as if I'm not there. I won't mind. I'll go on my phone and not take it personally. So thanks, gentlemen, for joining me and taking the time.
Yeah, thanks.
Thanks, Charlie.
Thanks. It's a lot of fun. Thanks, guys. Take care.
See you, buddy. Canute!
Yes, Howie.
How do you feel about Charlie and Don?
I love those guys. Come on, they're excellent.
All right. They are. Charlie, he just loves the markets. What can I say? He's got a CPA. He's a lawyer, but he loves the markets, loves putting scenarios together, loves writing. And I think that secret skill of all these people is they just crave, trying to not understand, because you can't tame the markets, but really trying to be prudent and manage risk. This game is not about how much money you make, but managing risk. So you were listening to Panic with Friends. Today was a market discussion. Most of the time it's Canute pushing buttons, but most of the time it's me talking to my friends who happen to be investors, entrepreneurs, traders, and venture capitalists. They're movers and shakers. And my job, I'm doing this selfishly, even though people seem to like this, is to try and just stay a couple clicks ahead of everybody and get a clear picture of what the next 1, 2, 3, 4, 5 years look like, sometimes 10. Go back in the archives. We try and make them evergreen. You can go search my name on Apple, Spotify, and now my YouTube channel, Howard Lindzen. Subscribe to Panic with Friends, and you'll get a podcast every week. Thanks, Canute. Thanks, StockTwits, for sponsoring. See everybody.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.
To where to invest their capital. But if it doesn't get bought and, crypto crashes and the equity markets crash and everything else goes to hell, I think we could obviously have some big issues in our hand. And, the respect for risk, I just don't think it's there. I think, for myself, I've seen the GFC and I've seen other markets and how to kind of, position myself if I want to go more cash and less equity, or, sell some crypto holdings and divest some stuff that I've made some gains in. But, on a fundamental basis, you look at the S&P, for information technology price to sales, the FANG's been between 3 to 5x sales on an average as a group. So, it's fairly stable. And then, if you look at their impact on market multiple, you do 2.7 times sales, ex FANG, you're at 2.55. So even with massive weight and revenue share, it's trading mostly in line right now. And 2021 is the fastest revenue growth period for S&P Infotech. It's 18%. That's in the last decade, since 2011. They're forecasting 9% for 2022, so it's above the average. So just seems to me that people don't think the Fed's going to spook the market. Seasonality's in favor, and we're going to get these pockets of rotation based on rates. But overall, the consensus to me seems be long into Q4, is what the message seems to be on the street.
Yeah, Charlie brought up the investing is easy. I think in January of this year, I just started using that. It started, I think, with Kathy Woods. Like, it was just Kathy Woods 24/7, 365, which is somewhat inspiring, right? Like, we need our next Gabellis or whatever we're going to call them. We need our next Warren Buffetts. But, they were just dooming her. The media was just dooming that she got all the capital, which is the end game. Suck up all the capital. Who cares about the return, because you get paid on the capital. And of course, everybody chased. And now I think she's down on the year, Charlie, or heftily down.
Yeah, I think down over 10% on the year. And most of the investors who came in, a good amount of them are probably underwater.
20 to 30%.
Which is amazing, even though she did so phenomenally well last year and years prior. So when FOMO takes over and asset AUM always follows returns.
Correct. Chasing anything, chasing a dog into the street, chasing a cyclist up a hill when you're not fit enough, you will, you got to be honest with your internals. You got to be honest with your system.
Something that goes up 100% can go down 50%, and you have to be willing to withstand that. And the investor expectations, if you talk to people in January and February, I wrote about this in February, almost on the day where it peaked. I spoke to someone who said, that the fund was up over 100% in 2020. Even if he got half of that going forward, he'd be fine. So he'd be fine with a 50% return per year. So that's where investor expectations were. That's how high they were at that point. And that's why the flagship fund was raising $1 billion a day with those expectations. And the interesting thing so far, and I think we'll probably see it in the next few months, but we haven't seen it yet. What you tend to see when a fund like that has had inflows coming in almost in a parabolic fashion, when it has a drawdown, you tend to see assets move out at a higher rate than the fund. So the fund's down a little over 30% from its peak there. And assets are down just about the same amount, meaning they haven't had additional outflows beyond that. And that's very atypical. So far, investors have kind of stuck with it. But, if this goes on for another few months, if these investors are like any other investors in the history of funds, they will start to bail and take losses and chase the next thing that's working, probably a commodity fund or crypto or any number of other things, right?
So
I agree with that on the institutional side of kind of where you're going to see fund flow. I think for the retail community, though, a lot of these, the Robinhood kids who were buying, GME and whatnot at all-time highs, the thought process for them was, we just got a stimulus check from the government. So if we lose $1,500, it wasn't ours to lose anyway. So who gives a shit?
Yeah, there's just no concept.
Yeah, they'll rationalize. We're in our 50s. We can't rationalize it anymore. We have to I hate using the term prudent, but I'd use it over the term conservative. I'm not conservative. I consider myself very aggressive, but I keep a high cash position as part of my aggression, right? Because I think it's prudent. The thing that kids...
you've lived through, Howard. You lived through 2000 when the market peaked. It took 7 years for it to get back to a new high in 2007, only to be hit with a worse drawdown for the S&P. I think it was 58% until a bottom in March 2009. And that took 6 years from the peak in 07. We didn't hit new highs until 13. So, you've gone through two major periods there where you had to wait years to get back in terms of just the broad indices, with many stocks obviously never recovering from that, right? So, just having lived through that, you don't have to go back too far. It's just the prior generation has had that. I mean, that's been a liability, by the way, having had that experience, because it's still in the back of your mind that it's possible.
Yeah, that recency bias takes a long time to wear off, and all the great investors go through it, whether you were a VC after the 2000 crash or a tech investor after 99. And, I think the number one thing here is, chasing, whether it's people or stocks, is dangerous. You can get away with it once in a while. But in the end, you surround yourself with a tight group of people. This is a team sport. It's my money, but I decided to make it a team sport. And I've tried to build the strongest team around to be able to pick up a phone call. It's like my own personal trading desk. I think the biggest mistake people make is they don't form a good team. They talk to too many people. And the sooner you write down how you really feel about how you want to make money and how you want to do it, the better, because that'll force you to read less. And there's nothing wrong with reading, but read fiction, read stuff about people that have been successful, but just reading endlessly about macro and the markets will just confuse you. You've got to find people that help you, reach goals. So I appreciate you guys checking in on this quarter. I think you guys have met in person, haven't you?
We haven't.
No.
Okay, so I'll coordinate that in the next few weeks in New York. We'll have a beer and catch up on all this stuff. Charlie with Compound Capital Advisors. He's prudently taking care of me and Canute.
Yep.
And then Don, who I have to talk to way too much, but and Charlie would know what that's like. So you can commiserate with Charlie when we have a beer. And you guys can talk as if I'm not there. I won't mind. I'll go on my phone and not take it personally. So thanks, gentlemen, for joining me and taking the time.
Yeah, thanks.
Thanks, Charlie.
Thanks. It's a lot of fun. Thanks, guys. Take care.
See you, buddy. Canute!
Yes, Howie.
How do you feel about Charlie and Don?
I love those guys. Come on, they're excellent.
All right. They are. Charlie, he just loves the markets. What can I say? He's got a CPA. He's a lawyer, but he loves the markets, loves putting scenarios together, loves writing. And I think that secret skill of all these people is they just crave, trying to not understand, because you can't tame the markets, but really trying to be prudent and manage risk. This game is not about how much money you make, but managing risk. So you were listening to Panic with Friends. Today was a market discussion. Most of the time it's Canute pushing buttons, but most of the time it's me talking to my friends who happen to be investors, entrepreneurs, traders, and venture capitalists. They're movers and shakers. And my job, I'm doing this selfishly, even though people seem to like this, is to try and just stay a couple clicks ahead of everybody and get a clear picture of what the next 1, 2, 3, 4, 5 years look like, sometimes 10. Go back in the archives. We try and make them evergreen. You can go search my name on Apple, Spotify, and now my YouTube channel, Howard Lindzen. Subscribe to Panic with Friends, and you'll get a podcast every week. Thanks, Canute. Thanks, DocTwits, for sponsoring. See everybody.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.
And manage risk. This game is not about how much money you make, but managing risk. So you were listening to Panic with Friends. Today was a market discussion. Most of the time it's Canute pushing buttons, but most of the time it's me talking to my friends who happen to be investors, entrepreneurs, traders, and venture capitalists. They're movers and shakers. And my job, I'm doing this selfishly, even though people seem to like this, is to try and just stay a couple clicks ahead of everybody and get a clear picture of what the next 1, 2, 3, 4, 5 years look like, sometimes 10. Go back in the archives. We try and make them evergreen. You can go search my name on Apple, Spotify, and now my YouTube channel, Howard Lindzen. Subscribe to Panic with Friends, and you'll get a podcast every week. Thanks, Canute. Thanks, DocTwits, for sponsoring. See everybody.
Howard Lindzen is the founder and general partner at Social Leverage. All opinions expressed by Howard and podcast guests are solely their own opinions and do not reflect the opinion of Social Leverage or StockTwits. This podcast is for informational purposes only and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast and should not be relied upon for decisions. Guests may maintain positions in securities discussed in this podcast.